Hey everyone, today I wanted to shoot a quick video on a market update in the multifamily market here in Southern California. We just got back as a team. We went out to NMHC in Las Vegas, which is a national convention for multifamily owners. There was a lot of investors there, debt brokers, you had equity partners, you had everybody across the industry meeting in Vegas talking about 2023. And some of the consensus was there's a lot of equity on the sidelines, a lot of people looking for information, not a lot of people doing deals right now. A lot of people are waiting to see what's going to happen within the market, and they plan to be ready in Q2 and Q3 of this year. And a lot of folks are looking at some defensive strategies with refinancing some of their existing portfolio, if there's construction financing or bridge financing, and they're putting on fixed financing right now, and we've seen rates actually drop. So that's been good to see, especially from the agencies. Fannie and Freddie have actually dropped their rates in order to get money out, and we've seen debt today be under 5% for multifamily rates here, and we're quoting and updating the properties we have available with that new financing. So that's helped get some transactions together. But more into the key takeaways, I think it's just a lot of folks are looking to buy. There's a lot of pent-up demand. I think there's rescue capital that's out there that wants to come into some of these deals where they need an inflow of capital. I don't think you're really going to see a whole lot of that in our neck of the woods here in Southern California. There wasn't as much bridge that was put on, a lot of floating debt. There is going to be opportunity within pockets, but I don't think there's any distress selling. At least I'm not seeing any. There might be some deals going down right now that haven't closed, but there really hasn't been a whole lot of pain out there. Fundamentals in our market are holding up. There might be fundamentals in other parts of the nation that are not as strong as Southern California. So if you have your NOI, your net operating incomes trailing down a little bit, and your cost of debt is trending up, you could get a double whammy in some of these other markets. I don't think we'll see that here on a macro level. You'll just see it maybe in pockets, and there might be an owner who has to come in with cash to buy down their loan, and they don't have that money and they need to sell. So there's a lot of equity out there asking me and our team to find those deals. They're just not really there right now. We'll see what happens, but we're still very optimistic within the market. We are putting transactions together, and again, we talked about this on a previous video. A lot of folks that are looking to buy, money is somewhat getting a little impatient and people want to buy. We're doing more or less some of the quality assets within the marketplace. Unless the cap rate's very attractive, it's got to be a quality asset. So we just closed in January. We closed 11 units in Carlsbad for $6,850,000. That was a low cap rate asset, well below the cost of debt that was in the threes. But that was an asset that was very hard to find. So an investor said, you know what, I want to acquire this. I get it. I understand the market. This is what I want to find. I don't think I'm going to see a whole lot of distress in Carlsbad. So this is a good piece of real estate. Another one was a building in Anaheim we just closed this week for over $420,000 a unit, which is a very high watermark for the city of Anaheim. But this was a quality asset, 80s product, all townhouse units, central air, pitched roof, balconies, plenty of parking on a great street. So it's hard to find that asset in any market, especially in the bottom of the market. So timing the best time to buy to layering in the right asset at that right time is really hard to do. So an investor came in and paid cash for that asset. And we just this week have put 3 other properties in Orange County under contract in the $5 to $10 million range. And one actually that's getting ready to close is going in a 5 cap. And the buyer was able to get 5.25 interest rate financing, a couple years of interest only, and that's hard to find. You know, the bank debt was getting close to 6%. Now we're back down to 5.25 today, sometimes under 5 if you go with agencies. So I think that's helping kind of balance the market and make it a little more buoyant. People are stepping in, kind of creating a little bit of a market. But that's on the transaction side and opportunity side. And we talked a little bit about debt on how it's lower. So that's a big thing. And anybody who's putting permanent financing on today is very mindful of making sure they have a shorter prepayment penalty schedule because they might look to refinance that loan in 2024 or 2025. So the step down prepays, people are looking at that, especially if it's like a 3-2-1, if they can get into something, or a 2-2-1. Some of these credit unions out there have a very good, attractive prepayment penalty schedule. So those are some of the things that we're starting to see. And then the opportunity, it's just, there's a lot of money out there looking, that's sidelined, waiting to see what type of opportunities come up, and they get the market. The 1031 exchange market, a lot of the 1031 exchange buyers went and placed their exchange and closed. And then the folks that were planning to do an exchange, maybe a lot of those deals didn't end up coming to fruition. So those trade buyers did never come into the market. So there's trade money out there. It's just dried up a lot. It's way down. And we're having to then focus on creating exchanges. So before, when the market was white hot, if you wanted to sell your down leg and go buy an up leg, it was really tough. It was really tough you'd have to sell first, build out some options to extend, and then go out and then structure the up leg. That was more or less how a lot of folks did it. Well, today, given that there's not as many offers as there was in general for properties, there was maybe 5 or 10 offers on properties last year or the year before. Now there might be 1, 2, or 3 in general. You might be able to put your up leg under contract before you sell your down leg. You've got to make sure that you've got everything flushed out. Your broker can arrange that correctly, but we have been able to put properties under contract, their up leg purchase, to eliminate that exchange risk in today's market. That's very hard to do. We were not able to do that before as successfully because there were so many other offers on the table for our clients. So that's an opportunity. The institutional market, we fly below that space. We represent high net worth private capital, but what I can see from my vantage point is not all the institutions are super active right now. So if you're a high net worth investor looking to trade up and get into a bigger asset, this might be an opportune time to then do that, because you're not having to compete with as many buyers per se. So these are some of the conversations we're having. This is some of the strategy that's coming into place with people that are trying to take advantage of 2023. Even though we're in a little interesting market, we got to watch where fundamentals are. We got to keep an eye on cap rates. We got to keep an eye on interest rates, regulation. There's so much going on, but there is opportunity through this. So we are navigating the market. We're looking for pockets of opportunity. And just the owners out there that are not doing anything, but they just want a market update, prices haven't really softened that much. Values are holding up. And we just want to make sure you're armed with that information as well. If you want any one-on-one information, or if you want to know what your equity position is in a property you own, let us know. Our team is here and happy to help. And we hope this market update was of value. Thanks so much for watching, and we'll see you on the next video.